So if you're selling a house in this environment right now with high interest rates, we're going to break down how to make your house stand out from the rest and save your buyer tons of money on the back end. I'm here with my good friend, Kevin Jones.
Hey, everybody.
And we're really looking forward to unpacking all this with you, Kevin. Thank you for being here, man.
Thanks for having me, Jim. I appreciate it. It was cracking me up whenever you first called and you said, hey, Kev, so you're going to come over here 10 o'clock on Monday. We're going to get all this knocked out. I was like, great. What am I talking about? Well, I need you to talk about X, Y, Z. And I'm like,
well, I mean, what else are we going to talk about?
Exactly.
Right now?
I'm like, okay, those are that's trending, right? So let's talk about the trends. But I loved it whenever I was like, all right, well, I'm not going to give my true opinion on all of it. And you were like, Kev, it's real talk with Jim Keaty. I'm like, all right, cool. So I just don't cuss. Got it.
That's it. And we can cut that out anyway. But,
okay, great.
Well, Kevin, I mean, besides being a good friend of mine and a mortgage broker here in Lafayette, tell us a little bit about your background and why you're here.
So, man, this was 12 years ago. 12 years ago, I was graduating college, didn't know what to do, and started over at Chase Bank. And that was in the first refinance boom after 08 and 09, right?
Right.
And so the beauty of me starting then is that I've got this 12 years of experience of knowing what it was like with high interest rates. And so that's kind of where my history comes in, because after that, once I started doing loans over at Chase Bank, I mean, I was refinancing everybody because the rates were going down. Right. So now this is my first time experience and really the rates going up, but I already knew what it was like with higher interest rates when rates were at 10 to 8 to 7 to 6, right? Because we were refinancing everybody. We got to see what these monthly payments were. We got to do the 2-1 buy down, which is something that we're going to talk about here. And again, I'll give my opinion on it. So 12 years ago, started as a little peon, making phone calls and just refinancing people. And now I'm one of 3 owners of Southern Mortgage Lenders here in Lafayette. And I know that was one big thing that you were helping me with. You were like, Kev, if you're working with us, man, you got to go on your own. You got to do it. You got to make it fun, take ownership. And I have to say, I appreciate that, because I remember mentioning it to you and you're like, I'm the owner of Keaty Real Estate from what, 12, 15 years ago?
Yep.
So, I mean, taking ownership.
A little bit longer than that, but.
All right. Let's not.
I don't want to show my age.
Let's not go Bill Bakke.
Yeah.
I mean, you said 30, and
Right.
I mean, he said, oh, I don't want to say anything about it, but then he dropped 50.
That's
right. It's like, all right, Mr. Bill.
Yeah.
Got it.
He's definitely the expert in this field.
Got it. So,
but you're the expert when it comes to structuring mortgages for your clients on the buy side.
And I mean, really, it all comes down to communication. It's our place to give the information, especially about the topics we're talking about today. This is just stuff, right? It's our place to have that communication with every client to inform them so they're able to make that right decision. So you have the loan officers who were financial advisors before, and they can sit there and have this conversation all day long with where the rates are going to go and what all the bobbleheads are saying. I can't have that conversation with them. I have that conversation with that loan officer friend who tells me everything, and then it gives me the input to go and look it up online and get more ideas. And so as professionals, it's just our place to help give the information, educate the buyer so that they know what they're getting into. So the psychology of it, the stress is lower, right?
Right.
And I mean, that's the beauty of dealing with 12 years tenured, 30 years tenured, you know?
Well, I think it's important too, because the fact that interest rates are high doesn't mean you can't still get a good deal or even get your interest rates lower than they would be. And there's some strategies that you're going to bring up today of how to look at this from a different point of view. But the fact of the matter is people will still need, their life is changing. You know,
That's right.
people are having babies. They still need to move up. People are getting, they're downsizing. We've got a huge tsunami of baby boomers that are going to be downsizing.
Right.
And for those people, we want to make sure they understand that there's a way to structure a deal in order to either sell your house and make it stand out from the rest, and also help your buyers buy your house, which is important.
Yeah, and it was fun that whenever we first sat down, you were making a comment like, this is going to be a little different. I'm with a mortgage lender. We're going to kind of talk about sellers, right? But let's be honest. This isn't seller versus buyer anymore. I mean, back, 6 months ago, whenever the rates started going up and the inventory was real low, again, everybody, go check out Bill Bakke's video first to talk about all those details.
That's correct.
That guy, I mean, that's just another level, right? So we go back 6 months ago where...
Which is a completely different environment that we're in now. I mean,
absolutely.
January was like, it could have been a decade ago based on...
That's where I'm going to. We had the lower rates. people started panicking a little bit because something was shifting, right? Inventory was low, rates were low, but they were starting to creep up. Everybody jump in and let's hurry up and buy, right? So it is what it is, but it's where was I going with that? And I know Tommy can cut some of this stuff out. Was that going into that from where it is now?
Yeah, you were saying going back 6 months.
Going back 6 months, whenever we have where we are now, the inventory is coming up a little bit. So you go back 6 months ago, people were jumping into it, right? And whenever they were jumping into it, but what was the exact topic you were going into with this?
Well, we were talking about how the sellers can make their houses stand out. Yeah,
being a team. So
you were talking about how the buyers and the sellers are more of a team now than before.
So yeah, let's go back 6 months ago. Buyers and sellers, we were a team. Loan officers were calling the listing agents, letting them know, especially if I knew the listing agent, which again, being in this for a decade, we've learned a lot of the agents that are out there. So that conversation with the listing agent, hey, listing agent, I have so-and-so's buyer, and they're a really good, solid buyer, and your pre-qualification letter's coming. Do you have any questions about anything? So a lot of times back in the day, pre 6 months ago, it was still kind of buyers versus sellers. And yeah, there was still some conversation, but a lot of the information was coming from the purchase contract, where now we got to all come in together and make this one full-blown transaction where listing agent, buyer's agent, lender, insurance people, we're all on the same page to try to help out and make sure that this transaction goes through, number one. But number two, help out the buyer and the seller to make sure that they're putting themselves in the perfect scenario. So pre 6 months ago, we weren't having a lot of that conversation. Now it is, because now the rates are higher. And so the sellers want to sell their houses. And that's where we start talking about things like 2-1 buy downs, you know?
Well, I mean, that's a great segment because I want to hear your opinion on these different programs. And then I also want to see how we can use them really just to help the ultimately help our sellers stand out and then help the buyers. But things are different. So, and there's some other strategies that I know you guys deploy all the time to help your clients.
Yep.
What are some of the things that you're dealing with right now? Obviously, a lot in the news right now is a 2-1 buy down, and you and I have talked about this.
Yep.
It's not always the best thing, but it is a great marketing part of listing the property to help it stand out and differentiate yourself from another.
Because anything helps. And so let's go back pre 2-1 buy down, right? A lot of times people are still. Go ahead.
What is a 2-1 buy down?
All right,
We're
cool.
talking
So
about it.
You want to just go straight into it?
Tell me and then we'll go back.
All right,
before
cool.
2-1 buy down.
All right, so 2-1 buy down. What it is, and the reason that the title comes up, today's interest rate, let's just use 7%. Nobody freak out. 7%, right? 2-1 buy down. Where the 2 comes in is that year one, out of 2 years, year one, your rate is going to be 2 numbers lower. So I have to be careful by saying 2 points, 2 this, 2 that. I'm going to make it real basic. 2 numbers lower. So today's 7.
If you're at 7, you're going to be at 5.
We get the loan qualified at 7 for a typical 30-year fix, right? But year one, your monthly payment, your principal and interest payment is going to be set up like it's 5. So 2 numbers lower. So year one, so payment 1 through 12, you're at what is technically a 5% rate. And then payment 13 through 24, which is the 24th month, your rate is going to go up one number. So it's going up by 1. And so now you're making that extra monthly payment. And then on payment number 25, your rate is going to go to the 7%. And that's where your normal monthly payment comes in. So how do we figure out the numbers on the 2-1 buy down? It's all off of the principal and interest payment. What is the difference between the principal and interest payment for year one, year two, and then you add those together, and that's got to come from seller credit, right? So let's use $300,000 for our example. So payments, if we're using 7%, payments number 1 through 12 or month 1 through 12, you're paying at 5%. So the principal interest on that is $1,557. Okay. So then payments number are 13th month through 24th month, aka the second year, your payments are put together like they're 6%. $300,000 purchase. So second year, your payment is at 6%, which is the principal and interest is $1,739. And then payment number 25 for the remainder of your term, you're at $1,929. And so all of those differences added up $6,744. Okay. So let's round up, $6,800. Seller has to pay for it. Buyer has to be buying their primary residence. It can't be a second home or an investment property. You can do it for all programs. Now, the kicker is that some banks or some lenders do not offer it. Being a broker, we've got 6 different lenders.
Sure.
8 different lenders, 12 different lenders if we want to, but being a broker, we have lenders that offer it. So with that being going into place, let's pretend that we're going to use $300,000 for our purchase price for the rest of this podcast. The seller has to be willing to give $6,744 to pay for the 2-1 buy down. And so what's the perk of the 2-1 buy down? It gives the buyer, the owner, ease of mind that my first year monthly payment is going to be lower because I'm going to refinance this thing whenever it's time, whenever the rates drop. And then the cool part, whatever money is left over from that seller credit, then you can actually put that as like a down payment towards your refinance. So it makes the buyer feel at ease. Here's Kevin's take on it. I'm not a huge fan of it because we all know
from the buyer's standpoint.
From the buyer's standpoint, the only reason that I'm not a huge fan is the psychology of it. You get comfortable for those first 12 months of that monthly payment, right? Mm-hmm. And then all of a sudden your monthly payment's going up almost $200. Mm-hmm. On when that 13th statement comes in, it goes up $200. There's a mild panic unless you have your phone reminders set on month 10, 11, and 12 that your payment's going up because you did a 2-1 buy down. And again, this goes back to where we talked about in the beginning, communication and making sure that the buyer knows what they're getting into.
That's right.
Because again, it's a real estate professional, lenders professional's job to over communicate this stuff and to make sure that they understand, right? Because we're going to be the ones getting the phone calls on month number 13. Hey guys, what the heck happened? My initial reaction to it is going to be, man, your insurance must have gone up or property must have got reassessed. Let me go look into it. So now I'm going to take 2 hours of my time to go figure out what's going on for me to turn around and find out, oh, we did the 2-1 buy down. Right. And so then again, it's on our side. So let's go back to the pro because I'm going to bounce back and forth between the two. Mm-hmm. Let's go back to the pro. It's my job that whenever rates drop to refinance you. It's not my job to wait for you to call me. Right. Because I'm definitely going to have a nice little exclamation point next to this one for John Doe. I did the 2-1 buy down on him. And so I want to make sure that when it's time to refi, I'm refining him into the 30. So there's no panic that his payment's going up. But hey, John Doe, this is where we have big boy conversations, big boy, big girl conversations. Let's make sure you set your mindset that you're paying $19.29. Maybe put that money aside and save it for something, or just make that monthly payment. And whenever you have hard times or you're ready to go to Disney and you're starting to save up for the family, start making the normal $1,500 monthly payment and then $1,700 monthly payment. So in my opinion, it's a psychological thing. Then let's turn around and just do a lot of this seller credit towards buying discount points. And doing a permanent buy down or buying discount points or just lowering your rate up front to where that monthly payment is set. If interest rates go up to 15, no big deal. You spent $3 or $4 grand to get your rate from 7 to 6.5 or 6.25, and you're good. You're set with that for 30 years or in the time that you're in the house. I'm a big fan of that, but that's also because I'm old school. It's what I'm used to.
Now, so let's go back because I want to dive into the 2-1 buy down a little bit more.
All right.
Because there are some caveats to that. Like obviously, you know, your client, the buyer needs to be aware of what they're getting into so that they understand it. I mean, ultimately, the strategy is you believe that the interest rates are coming down. So you're going to do a 2-1 buy down so that you can refinance in the third year or the second year to long-term financing at a lower price.
That's right.
Now, and the reason this helps the seller is because you can offer it up front. It's a seller concession.
That's right.
And it makes your house stand out a little bit more than the other competition.
Absolutely.
Right? Now, the thing about that is, though, like we were talking about a $300,000 house. You've got a, we said the difference was $6,740, correct?
Right.
So that's what the seller would contribute to get that 2-1 buy down. Now, if you and I were talking about this on Friday, that on a VA you can only have a 3% 4%.
Yeah, 4%.
4%
on VA. That's right.
Max seller contribution.
Right.
And if you're a FHA, it's 3%. So
FHA is 6%.
6%. I'm sorry.
Yeah, that's right.
Conventional is 3%.
Conventional is 3% under 10% down.
Yeah.
That's
So if you're in a conventional under 10% down, if you're putting 5% down, you wouldn't be able to do this 2-1 buy down because it's going to cost more than what than the max seller contribution. So what's important, from my understanding, is you've got to still fit within those parameters for the buy down for the seller contributions.
So let's build on that too, because the thing that I want to talk about on top of that is the communication of it all. And so let's pretend John Buyer, let's use Jane Buyer. I'm leaving the girls out. Jane Buyer wants to go buy the house, right? Jane Buyer sends in a pretty good offer to buy the house. But now, let's use some of your agents, right? Brittany Thompson is my buyer's agent. Emily Babineau is my listing agent, okay? It is our job. Let's pretend that they're going back and forth. So why don't Kevin, Brittany, and Emily get on the phone and work all this out? Hey, guys, what's the best numbers we can do? What's this? What's that? Get it all worked out on the professional side to where, hey, guys, we're doing a loan program. I don't have enough limit to go up on that credit. So let's look at this. Let's look at that. Let's have that conversation because that's what we're supposed to be doing as professionals, right? Everybody's in it for the same ending. Let's get this house closed. Let's help our sellers move on to the next phase. Let's help our buyers get in here. But again, you're given a lot of info. So that's hard to keep that going back and forth. And that's going to waste days and just cause stress for everybody. Everybody just get on the phone. Stop texting, stop emailing, get on the phone, figure this stuff out.
I'm a big text.
Right?
I'm
just
against,
get on the phone.
Like I'm talking to somebody in my family. I'm not going to mention who it is. I'm sure you can figure it out. And she's wondering what this person is talking about on a text. I'm like, hey, look, it's real easy. Let's just pick up the phone.
There's still a microphone and an earphone on these phones.
We can just pick up the phone and let's try to coordinate it. And and you know, you know this because like I will, if I ever have a question, it's always better to over communicate. And the best way to do that is to use that 3-way function on your phone and just 3-way everybody to really dive into like, what's the problem? What's the issue? How we can all solve it. Because
here's my thing. I feel like everybody's afraid to sound dumb.
That's true.
And it blows my mind. Yeah. I'm the first guy, again, 12 years doing this. I'm no professional. I'm no expert. Let me rephrase that. Take that out, Tommy.
Yeah.
I'm definitely a professional.
I would say, you're definitely a professional and expert.
So here's the thing.
No, I would say you're an expert.
Right. Loan officer and realtor that's been in it for a year and it had to go into the school of hard knocks, had something fall through, they fixed it. They're officially the same amount of expert that somebody is for 12 years, right? Somebody is for 30 years. But we've been through a situation where in that 12 and 30 years, now we know how to navigate around the minutia, nor do we have the fear to sound dumb and to get on that conference call and say, hey guys, this is going to sound really stupid, but what do y'all think about X, Y, and Z? Do y'all think this can happen? Because everybody is in their same field. Seller is abiding by the seller. They know what's going on with the sellers. Buyer's agent knows what's going on. I'm sorry, listing agent for seller. Buyer's agent knows what's going on for the buyer. I know what's going on with their financing, which I'm not going to let them know, but I'll give them some parameters. Hey guys, how can we figure this out? Everybody's afraid to sound dumb, and I'll never understand that because I'll be the first one to ask a dumb question to move on the process to keep it going, and people appreciate it. But where's the fear coming from? People pick up the phone, make a phone call.
No doubt.
You know,
and like, let's go back to these numbers real quick because we got a $300,000 house.
Yep.
And we know that you're not going to be able to offer a 2-1 buy down if it is conventional and the buyer is putting less than 10% down.
So what's 3.3? Let me pull up my handy dandy calculator. Oh, look, I mean, the phone's a calculator too, right? Times 0.03. So yeah, we're at $9,000. So you can. So $300,000 doing a conventional under 10% down, you can do the 2-1 buy down.
You can do the 2-1 buy down.
Yeah, because the max is 9,000.
Oh, because it's 3%.
That's right. 3% of 300.
Okay.
And again, I'm never going to have that off the top of my head. You were doing great math in your notebook.
No.
I'm the guy who's going to grab the calculator right off the bat.
And that'll leave basically $2,300 left that you could still max that out. So you can max out the seller contributions.
That's right.
In this case, if it's a conventional, you could go up to $9,000.
That's right.
And then
still
offer that other $2,300 as a seller concession for closing costs.
Yep.
Or what about buying down another point?
Well, let's pretend that we have that conversation with the listing side. We're trying to balance it out. Let's pretend we have that 3-way phone call, right? Mm-hmm. What if the seller turns around and says, hey, I don't want to, or the listing agent says, hey guys, I'm looking at the market for this house and we can go up, because they're going to balance it with their purchase price typically, right? Seller wants to walk away with a specific dollar amount. And so that's again where that conversation comes in. So let me answer your question first. Yes, absolutely. If the seller is willing to go and max out the seller credit and bring it up to 9,000, absolutely. It's going to pay for some of the other closing costs. If we want to turn around and take that 7% and lower it to 6.5% because we have enough dollars to do it, then we're going to do it. Let's say we don't max out the 9,000. There's $100 left over. Okay, cool. So it's going to pay for something else that's in there. So yes, to answer your question, because I will go off the beaten path away from your answer.
So that's a conventional, where the maximum contribution from a seller is 3%. If you're doing FHA and it's 6%,
that's right.
You have a lot more flexibility to potentially buy it down even further.
Agreed, you do. But as you know, on the real estate side, that's where we have to be careful with appraisal. We have to be careful with how is the contract going to be set up, because those appraisers are going to see that big seller credit. And then if the appraiser doesn't have the wiggle room to be able to, let's pretend that seller cranked up their price a little bit higher than the market, they cranked up that price a little higher than the market, then that appraisal might come in a little lower. We're back on the negotiating table.
Right.
But that's where it comes back to communication. Listing, buyer's agent, lender, let's all get on the phone and hash all this out.
That's right.
Obviously, we got to talk to the sellers and all that, but we're there for representation for all these guys.
And to go back to that max contribution, just so I'm clear, because I did make, I was talking about, 6% versus 3%.
Yeah.
FHA is 6% maximum contribution.
That's right.
VA is a 4% maximum contribution. Yep. Conventional with less than 10% down, you're looking at 3%.
Yes. So
maximum size.
Yeah. So conventional has a nice little scale, and if I get a couple of numbers wrong, oh well, I'm close, right? Because again, that's why we have the internet. 10% down for conventional is 3% max. 10 to 25% is 6% max seller contribution. 25 plus, they can go up to 9% max contribution from the seller on a conventional.
Okay.
And then RD always kind of gets shaky on. It's between 4 and 6% for RD.
Yeah.
And the next time you start talking about something, I'm going to go Google it while we're talking about it.
No, I'm glad you brought it up.
As we talk about, we're the professionals and experts, but let's be honest, we're the ones who just know how to go look for something, get the answers, and move it forward so we don't run into any issues.
And it's just so everybody's clear that you still have to be approved for the sales price.
That's right.
And it still has to appraise for the sales price. But it's in certain cases from a listings perspective, it's just another variable that you can manage a little bit better than the rest of the competition.
Yeah.
In order at least to have that conversation, of course, the buyers have to find the right program that fits their lifestyle.
Right.
I had said something the other day. We're talking about being experts and being wrong. Well, back in 2008, when we, the peak of my sales career,
Gotcha.
when we were selling, when I was personally selling as much as I possibly could, we had ARMs, adjustable rate mortgage,
right.
and that's why we had the fallout from in 2008, because a lot of people before got into these adjustable rate mortgages,
right.
And when that rate increased, then they couldn't afford their house, and then they lost it, and that was part of the reason it fueled that problem. Now, what's interesting today is, and I was proven wrong by my friend Charles Ditch, back in 2008,
me, unfortunately.
it was which we validated with you that this was correct. That ARMs used to, when you agreed to an adjustable rate mortgage, you used to be able to get much lower interest rate than we can now. And now it seems like everything is about the same. An adjustable rate mortgage is about the same as a 30-year mortgage.
It's a little bit higher right now, actually.
Yeah, which is fascinating, and it doesn't, it kind of contradicts what we used to think, that the adjustable rate mortgage was less risk to the bank, so you should get a better interest rate.
Right.
But right now, that's not the case.
That's not. And so I loved it whenever you gave me that call and you said, Charles is crazy. I said, Jim, I'm sorry, Charles is right.
Yeah, that's right. You got it on camera here. Y'all
That's
were
right.
right and I was wrong.
That's right. Charles, calm down. It's going to be fine. All right. So whenever we looked into it, to be honest with you, I had never actually jumped into the rabbit hole and said, let me go check out these adjustable rates, because every time I was looking at my rates and everything, I would just see those arms on there and I'd move past them, because the 30-year fixed, even with the 2-1 buy down, even with the discount point, buying discount points to lower your monthly payment, the 30-year fixed is still the jam, right?
Yeah.
So before I go down a rabbit hole of talking about all the rates and all the things, so yes, the adjustable rate is a perfect example of me talking about why I lean on not liking the 2-1 buy down, but why the 2-1 buy down is still better in comparison than doing an adjustable rate, because a lot of these adjustable rates, the better rate was for the first 5 years. So you tell me, Jim, if you're making a monthly payment on something for 5 years and then all of a sudden it adjusts and you get a statement that comes in and it's $300 more per month, you're going to flip your lid. Mm-hmm. Am I wrong?
Yep.
So, no, I'm right.
Right? Yeah, you're right.
So I'm right. So
you are right.
You're going to lose your mind. Now with the 2-1 buy down, the expectation is there. So that's where the pro side comes in, especially versus an ARM, because an ARM, you've gotten accustomed to doing that for 5 years, right? That's 60 payments. On month 61, all of a sudden your monthly payment jumps up. You forgot about it.
Yep.
The 2-1, you're expecting it.
That's
right? You're doing it for a year.
You've got to expect it, and
that's right.
You're doing it in hopes that the interest rate's going to go down. You're going to refinance it.
So yeah.
And
it's on the back burner, but it's still there. You do an adjustable rate and you do a 5 or a 7 front end. After the first 2 years, we've gotten busy. We had another kid on accident. We got different jobs. Something changed to where we forgot about our monthly payment, and then pop, month 61, you remembered your monthly payment real fast. You're freaking out.
But here's in my mind, here's the differences. The lenders. So back in 2006 and 7, I mean, when we were doing loans, it was much easier to get approved.
That's
you
right.
didn't have to verify income or
Do you remember
a lot of
something
other
called
things.
a ninja?
Yeah, I remember Ninja. We called it something else, but
I don't want to know.
The point is we're not in that situation. The banks are still approving the buyers for the full amount, for the normal price of the loan that's going to be for the 30 years. So that's, I think, is a misconception. Two things. Yeah. And just in the last week, I've had conversations with some more experienced guys, investors and the baby boomers who saw those adjustable rates back in the 80s and the 90s and then of course in the early 2000s where the interest rates on those adjustable rates were less.
They were super low.
People were qualifying for these loans, and then when that adjustment happened, they were no longer able to pay that note.
Right.
For lots of different reasons, now that adjustable rate is not even an option. It's not even on the table because it doesn't make sense because it's the same interest rate as the 30-year fix. So why would you even consider that?
You wouldn't.
Right.
You wouldn't. What's the point? So the federal government stepped in, right? We had the mortgage crisis of 08 or the mortgage crisis of 09, the correction in 11, whatever names you want to call it. So when we go and we buy a gallon of gas, let's be honest, a big chunk of that money is going into taxes. So after the mortgage crisis, what they do? They stopped the ninjas, the no income, no job loans. They stopped that. They came out with Dodd-Frank. I think I'm saying that right. Man, I mean, it was so recent but so long ago, and now we're just jumping in. So they changed everything a little bit. So for the adjustable rate, so 30-year fixed, let's pretend it's at 7. Back in the day, the adjustable rate might have been at 4 or 5. Right? But now
that's right.
Federal government stepped in and they're like, no. You're going to pay this much more to the investors, to the Fed, to the this, and whatever it might be. I'm probably getting some stuff wrong. But
to ultimately deter that.
To keep everybody doing the 30-year fix, to keep that mindset on their budget. Cool.
Yeah.
I got a new job. I can spend more over here, but my mortgage is going to be paid. Yeah. Right? And so going back with those ARMs, still just not worth it. Even the 15 years. I remember whenever I first started that I was refinancing somebody into a 7% from their 10%, right? And they were asking me, well, what's the 15-year term look like? Well, the 15-year term was almost a high 5, low 6 interest rate, where now even the 15-year on the 7 is 6.8, 6.7. So
Right.
it's even that's not worth it.
Yeah.
And there's no like try to influx or try to change anything. But here's the funny part. Let's go back to when COVID was a thing, right? Back when rates were tanking, the lenders legitimately shut us off and said, stop. You can't. If you're going to write a mortgage, you're going to be paying 4 or 5 points.
Right here.
Kumsa, 4 or 5 points to write this mortgage right now.
So you're like, we were in 2019, we had 2018, 2019, and then 2020. You can see right where, the interest rates just plummeted to try to keep the economy going.
Yeah.
And then
but what were we doing on the sales side? We were refinancing everybody. All the lenders were flooded. You couldn't find a lender for a good 45 days that they would even let us lock a rate. So people that were still buying houses in that time, because woohoo, refi boom. But it's our job to also help our realtors for people who are still buying houses. Because what do you want to do when you see the house that's been listed for 60 days and all of a sudden right here in the last few months, it just starts dropping like a bad habit? And we can get you from where it was at 5% to now high 3s, low 4s. You're going to still want to buy that house. And now the lenders locked us out. Right. They're like, nah, man, stop. Time out. And so they're still sitting under contract because we need to lock them in before they go and finish the contract. Right. Right. And so when people are like, right now is so terrible. No, back then, before they opened it up and let us actually start refinancing people and lock in loans, that was terrible because that's where you have no control. Right. The professionals are literally out of control at that point. So how do you think the buyers and sellers feel? The consumers, they're losing their minds too. Okay, well, when's my house going to sell? Whenever we can lock in a rate. Right. And we don't know when that's going to be,
Well, and we were talking about, this as a being a different situation. And I think this is an important conversation for us to have to make sure people understand that we're in a completely different.
Checking the time.
Yeah, to make sure that people understand that we're in a completely different environment than we were in 2007 in the way that, because I actually was having I was having a little happy hour drink over at Ruth Chris on Friday with a good friend of mine, and we ended up running into a guy who was like, his perception was, well, you got 2-1 buy downs, you got all these people who are buying their properties. Well, in a couple of years, they're all going to foreclose. Well, that's not necessarily the case because the difference between 2007 and today is that the people are qualified. They have jobs. They've been verified. Yeah. This is not lenders going around just giving out loans to anybody. Yeah. They're different modifications and a different strategy. Right. But the consumer is way more educated on what's happening. And these are not risky loans. I mean, they're getting approved for the loan as if it didn't have a 2-1 buy down.
That's right.
So, because all the 2-1 buy down is just a seller contribution to make that house a little bit more attractive than the other ones, right?
You got it. Yeah, absolutely. And so again, going back to the way it was, and I'm gonna coin a movie, The Big Short, right? Yep. They did a pretty good job, especially for the guy who's been doing it for 10 years, who got into it right after everything changed. And I mean, I saw the transition going into it, but I didn't know it pre the 10 years. So the guy that's in it for 20 years, he gets it. He saw the shift. He saw the ability to do no income, stated income, no assets, going in and buying a house and doing the non-conforming, but also where the interest rate was 12%. And this was the person's second and third and fourth and fifth home, right? Right. Where the lenders were just throwing money out there. But also they were doing yield spread premium, where the lenders were able to make a little bit more on somebody with a higher interest rate, right? That's all gone now. That's all gone. So is it honest lending? Significantly more than it was before then. Right. And so when it comes to disclosures, that's where Dodd-Frank came in. Let's give them 3 days whenever they get their closing disclosure to figure it all out. Let's give them 3 days, which you can waive for your appraisal to figure it out, to see everything, right? Because everything is now pushed to being consumer, overly disclosed, eliminate liability. Now, do people actually look at the paperwork? I hope so. I hope so, but it's a lot of paperwork for them to go in and e-sign. But on the front end, like you said, they are significantly more educated and cautious about what they're getting into.
Right. So, I mean, because of that, that is really what drove the bubble. I'm not saying there's not, houses
behind it. Yeah.
Right. I'm not saying that, we haven't experienced appreciation at levels that we're not going to, that's unsustainable. However, the the actual fundamentals of that buyer being able to pay that loan doesn't change unless they lose their job. And that could happen, but it's not going to happen from not being able to afford their payment in 3 years because they're being graded and accepted into this program based on their ability to return payment to the bank. So
I think 2 years isn't that long. Let's be honest.
Right.
So you did the 5 year on the ARM. You weren't used to it. The 2-1 buy down. I mean, it's coming up.
Yeah.
And so again, the psych of it, the pro is that your monthly payment's coming up in a short period of time. The con, you still might forget about it.
Yeah.
And
so let's talk about that. Let's talk about in 2 years. Okay.
Good.
So if I was to sell Danielle and I's house today, and I did a 2-1 buy down, I offered a 2-1 buy down to my buyers. I do a 2-1 buy down on my next house. The reason we're doing that is because of this. This is the expectations.
There you go.
Right here. So what we have here, this is Freddie Mac, Fannie Mae, the Mortgage Broker Association, NAR, all of their projections for 2023.
The people that are smarter than us.
Exactly. Now, they don't have a crystal ball either. So they have been wrong in the past. So this could be wrong. But
I really love like the other podcasters that are sitting there saying, don't ever tell your client I don't have a crystal ball. Why? I don't.
Yeah.
I really don't. I have no idea. But let's make sure that your budget's good. So let's do 30-year fixed. Are you comfortable with this monthly payment? Cool. Let's roll.
Yeah, and I mean, actually, none of these experts at the end of 2022 ever predicted the rates to be where they are today. So take this with a grain of salt.
So how about that crystal ball, right?
This is where they're projecting it to be in the next, first quarter of 2023. They're expecting it to be, in just under 6%.
Right.
And then in quarter four of 2023, just under 5.5%. Now, of course, you got like NAR, the National Association of Realtors is 6.1 is their prediction. You can see the association, the Realtor Association, in all 4 quarters is expecting it to be higher than the Mortgage Broker Association, Fannie Mae, and Freddie Mac. So, that is why we are seeing 2-1 buy downs right now, is because their expectation is, although interest rates were at such a low rate for the last 24 months and that can't be sustained, they're feeling and predicting that that's going to be the same thing on the upper end of that.
That's right. So again, that's where I go back to, let's just 2-1 buy down be darned. If you're comfortable with this monthly payment, let's just set this in for 30 years so nothing shifts. Set it and forget it, right? R.I.P. Billy Mays. But when it comes to the 2-1 buy down, with where these are coming from,
you can still refinance in 2 years.
That's right. That's right. So let's go back to our little fun friend, the Treasury yield. So this is for the month, right? Had a nice little dip a month ago, came up and it dropped again. Why? So many factors. This would be a whole different podcast that I would legitimately get a financial advisor.
This is the 10-year Treasury yield.
This is the 10-year Treasury yield, which is the inverse of the bond, right? So what's supposed to happen?
So why is this important when we're talking about interest rates?
Great question. Glad you asked, Jim. So it's important because this gives you a good idea of where investors are putting their money, right? The Fed, whenever the Feds go up and raise interest rates, this is a very good indicator of what are people doing? Are people going to take their money out of the private sector and put it into the government sector, right? Because if this is the inverse of the bond, what people want to do is they want to take their money from the private sector, throw it into the government bonds, the Treasury notes, so that the money can still sit there while everything's going crazy in the private sector. And the money can still typically, because everybody's investing in it, go up a little bit. Well, if that's the case, then in the private sector, what's the best way to entice people to spend money? Lower your monthly payment. Lower your prices, lower your interest rate. So Fed comes in, Fed says, hey guys, we got to slow down inflation. Go back to Bill Baquet's podcast. He'll tell you all about the inflation stuff. So we got to slow down inflation. We are the children to these Fed guys, right? They are our parents, the Fed and the government, where they said, we got to stop everything. So let's make everything very expensive. So everybody stops spending money, right? So the Fed fund controls all of the interest rate, how much it costs to get money to borrow money from the Fed. So banks borrow money from the Fed to then turn around and lend it out to other people. So everywhere in the interest rate, just like buying discount points, that's where all of the revenues come in. The interest rate's a little bit higher. So it builds up from the Fed. And I forget what today's Fed fund rate is where it's set, but everything is inflated from there. Bank goes in to borrow money from the Fed. So they're paying X amount of dollars to do it. And then they're going to lend it over to so-and-so who's going to pay a little bit more to do it. And then it gets to the consumer at 7%.
Yeah.
Right. So this is just a very good indicator of what is about to happen or what can come down the pipeline. So again, whenever I was a young loan officer, I didn't watch this. I didn't watch this for the first 3 or 4 years because I was just refinancing people. Hey, your numbers are lower. Go for it.
Is this as of today?
This is as of this morning.
This morning?
Right. And so I did the 1 year and the month, but this is as of this morning over here to the right.
Which is interesting because typically we see interest rates about a 1.7 spread by the 10-year Treasury and where interest rates are being.
So good point. Because
and that's not what's happening
One
right
of the
now.
parts that I was going to get to is that because there's such a huge shift right now, the banks don't even know where to put their interest rates, right? Mm-hmm. So they're just saying, look at this huge jumper. Let's go back to where you were over the last few years. So the private sector is sitting there freaking out because they don't even know where to set their numbers. Mm-hmm. So what do we need? Do we need a drop? No, we don't need a drop. We need a level off. We need everybody to stop freaking out.
Yeah.
Let's let it level off for a second. So my opinion, the last time the Fed raised the rate, they were talking about all the inflation numbers and whatever the acronyms are. I'm not going to bore everybody with it, but they were looking better. So my biased opinion was, hey, Fed, don't raise the rate. Let's watch and see for a minute. But they're like, nah, one more. Let's just throw another one in there. And then the market kind of panicked a little bit, and then it leveled out. And I think there's another one supposed to be coming this week or next week. But as long as, and you and I can attest to this, Tommy, Andrew, we can all attest to this. All we want is something to just slow down so we can actually think for a second.
Right.
These guys don't have a second to think right now because it's all over the freaking place.
Yep.
And so as we all know, when things slow down, that's where the private sector gets to jump in and start making decisions. Hey guys, do we want to lower our interest rate? Do we want to lower how much we're going to make whenever we lend these brokers or these lenders money to be able to help them close a loan? Because again, how does competition start up? You make things cheaper, right? So if this levels off hopefully, if this ever levels off anytime soon, that's when we're going to start seeing competition again. That's when we're going to start seeing supply and demand going up again because the consumer can start making easy decisions.
Yeah.
And get used to the 7%, 6%. Because like you said, I don't see a crystal ball right here.
Right. Nope. And, if you go back to where they're going, I mean, what we are predicting is this, but that could change any day. There's lots of variables that'll affect that.
I mean, the last time it was the Russian-Ukraine war, it looks like they're still fighting. Gas prices went up and then they're dropping again. So it's like, what excuse?
And I think the important, like if you're a home seller in the market right now, first of all, Lafayette, if you're in South Louisiana, we're still very low inventory. Yeah. It's absolutely, in general, depending on where you live and your price range, all makes a difference. But in general, you are dealing with a seller's market. So it's a great time to sell. It's never been a better time to sell the last, really 18 months. But we're at the peak right now.
Right.
Prices are still going up, and that's because inventory is low. Now, interest rates play a big factor on that,
absolutely.
And interest rates are high. What did Bill Bakke say? We've got the 3 I's, right? Interest rates, inventory, and insurance. And we're going to talk about insurance on our next show.
Sweet.
But really want to focus on, if you're a seller, is it a good time to sell? The answer is yes. Now, if you're buying another house, you have to be a little more strategic about what you're going to do, and you got to look at some of this data. Talk to an expert like you to figure out, hey, should I go ahead and move now and do a 2-1 buy down? Should I get a discount point?
Right.
And it all depends on your personal situation.
Or do I want to sit there and hold on to all my cash and not pay for any of that stuff and just go with the 7% and refinance it in the next 6 months to a year if the rates do go down? Right.
The one thing we know for sure,
it's all about having the conversation.
You should not be thinking about is renting.
For sure.
This is the median asking rent going back to 1988. The one thing that is consistent in our country that we can count on is with inflation and with the rise of everything, rent is going to continue to go up. So we talked about this before. Interest rates are high, but it's still a better, you still are in a better situation to buy than to rent, you know.
Somebody says 100% interest for rent.
Right, that's correct.
I love
100%
it.
interest.
I love it. That's
what
the
it
best
is.
explanation of rent.
Yeah.
And I mean, in my opinion, again, biased opinion, rent something until you're ready to buy, right? Get out of the 100%, take some ownership, go into the 7% or the 2-1 buy down, or buy down your rate a little bit. But renting is only going up because everybody else with inflation, with oil prices, with all of this stuff, those guys that own the house, they need to make more money too. If expenses go up, we got to offset it with our income.
Right.
So, I mean, the investors that own rent houses, they're just, whenever it's time for that lease to come up, their rent's probably going to go up with it.
Well, what else should we hit before?
So we talked about down payment assistance. Do you feel like we covered 2-1 buy down pretty good?
Oh, I think it's perfect. Yeah.
Sweet. I feel like we also kind of went in the generals, went around a little bit of everything.
Can you repeat it? What's the 2-1 buy down?
Yeah, Peanut, tell us everything. All right, let's see. Let's talk about down payment assistance a little bit, because that was fun the last time.
We didn't talk about that.
We did. So down payment assistance. Tommy?
Okay, well let's frame this up. So I'm going to ask you a question to frame it. So
what you got?
So Kevin, what are some of the strategies that we can unpack today? We talked about down payment. Sorry, cut that out. All right. So now that we've talked about 2-1 buy downs, what are some other strategies that a seller can do to educate the buyer and make their house look better than other properties?
Right. So the seller can always offer closing costs, right? That's pretty much where the seller stops, right? Let me just give you some money, Mr. Buyer, so you have more options, Mr. Buyer, to be able to go through and get stuff. And so let's pretend closing costs, they're offering closing costs, or the buyer comes in and asks for a closing cost. Let's pretend that the listing agent did a really good market analysis on this house, and they feel that they can't bring their purchase price up to cover any closing costs because it's just tight, whatever the reasons are. Then we talk about down payment assistance. That was really interesting whenever I started seeing a lot of these lenders on the broker side start advertising to us, here's the down payment assistance programs in your state. Here's the this, here's the that. And I started getting phone calls, and I'm like, hey guys, even back when the rates were here, you could still do down payment assistance. It's no different, right?
Yeah.
And so it was just very intriguing why down payment assistance pops up. But let's be honest, it gives us lenders something to talk about. Yeah. Let's talk about it more. Let's go into the real estate broker's office and give us something to talk about. And I know you saw one of my emails that came over here, and it started with the lyrics of let's give them something to talk about, right? So down payment assistance here in the Lafayette area, especially for Lafayette Parish. And Tommy's going to put the link in how do I say it, Tommy? The link in the description below. I feel like I'm a YouTuber now.
Yeah, that's all good.
The link in the description below for the website to be able to go look at first-time home buyers being able to do the Lafayette Public Trust Financing Authority to do their down payment assistance program. Here's my take on down payment assistance. There's always something built in. There's always a little catch. It's extremely rare that there is a grant to take care of down payment assistance. It's usually something. Lafayette LPTFA, Lafayette Public Trust Financing Authority, it's a loan. It's a little 15-year, real simple 5.5% interest rate. They go up to $8,000, but you qualify for it on top of the loan also, right? And it covers any closing costs and down payment you need. And there's a lot of down payment assistance programs out there, but just know it's extremely rare that something is a grant. There's always a caveat to it. I was at a previous lender before where I can actually do this still as a broker. That's called Capital Area Financing Authority, or CAFA. And so a lot of times they actually stated that it's a grant, but our interest rate is a little bit higher to be able to do that. So it's really not a grant because the money's coming from somewhere, and it's the interest rate, right? And so it costs about one discount point to make the interest rate right. So as a salesperson, how did I position it? I called it the 1% conventional, because it was a CAFA loan doing the conventional program. And the minimum that you can come down on the conventional is 3% if you're under a certain income limit, or the other minimum is 5%. But with this CAFA program, that money can come in to where you're only paying a discount point, which is 1%. So a conventional 1% down.
Yeah.
We're all salespeople. We want to help people be able to come in and get enticed, for us to be able to do the numbers to find out what's comfortable.
So that's an interesting strategy. So you're going with the down payment assistance program, but then you're buying down a discount point
because the interest rate was, so let's
because the
pretend
interest rate's going up with the down payment assistance program. You're buying it down using the seller funds.
You got
which
it.
Is
a
great way to handle it.
That's right.
If you qualify, because there's income limits for
and so
all
it was
of these.
Easy. That John Doe buyer, Jane Doe buyer, was also telling their neighbor that they just bought the house. Well, Kevin Jones did this conventional 1%. Well, what's that? Right. So that next conversation is just easy for someone to talk about. So yeah, absolutely, I was doing it, and it was just a down payment assistance program.
Well, I wanted to ask you another question. So we just talked about 3 different strategies that a seller can deploy to try to stand out, and those are also 3 strategies for a buyer. Even if the seller's not offering it, you can always negotiate that in the sales price. But you've got a 2-1 buy down, which everybody's talking about. We know the benefits and the negatives to that, and then you've got buying down a discount point, and then you've also can deploy the down payment assistance program strategy with any of it. But one thing that we're not talking about, and obviously it's not even on the radar right now, but it was back in the 80s, was loan assumptions. I would imagine, like, some of these sellers, they have such good rates now, because even if you paid off your house, a lot of people refinanced, took the cash out, and they still have massive amount of equity, but they've got these loans that are at 2.5%. When are we going to start talking about that? And do you foresee, I guess all of that is determined up front whether or not that can happen from the lender, but do you think some lenders are going to maybe possibly offer that as an option?
Some of it's already in there. And the only thing that I'll say on that, because I will be the first person to tell you that as a mortgage professional, I have not looked into it or anything like that. But let's pretend somebody's about to sell their house. That is a really great phone call to their servicer, whoever's taking care of their loan at the time, to have that conversation with their servicer, make the phone call. It's going to take 30 minutes to an hour because you got to hit all the buttons to get to the right person. But use the verbiage. I'm thinking about selling my house, and I just want to know if my loan is assumable. And then they get to whoever it is, and they figure it out from there. They got to find that person or that department within their servicer who's holding on to it to let them know that. Because I don't want to sit there and try to give specific information.
It's just an interesting conversation because,
make that phone call.
If you have a $500,000 house and you've got, $350,000 in a mortgage at 2.5%, that could really make the purchasing power for that buyer way higher. So if that is a thing coming, that would be really interesting to talk about in our next podcast.
Absolutely. But then what happens to that equity? That's where my question comes in. So if I've got $200,000 in equity and buyer comes in, this is where I'll show people as a professional, I'm dumb. Things that come in.
It has to come from the buyer. To either.
So buyer comes in with $200,000 to assume that the rest of the $300,000.
You would have to have You'd have to have a buyer with some dough, or you have a house. Let's say it's $300,000, and your loan to value is 95%. They would still come to the table with whatever
it is to pay you off.
But anyway, I thought on a side note that was interesting. So do you see or foresee, are you getting any calls with people who are having a hard time with making their payments right now? I mean, that's not I want to make that clear, because we've seen an all-time low of foreclosures. And the idea that the people aren't going to be able to afford their houses it's a different scenario now than it was in 2008.
That's right.
Because 2008, some people didn't lose their jobs; they just couldn't afford their note anymore. Whereas now,
because their arm was adjusting,
it was adjusting at a much higher.
They weren't ready.
But now it's about can you as long as you don't lose your job, you should be fine.
Here's the thing: go back to when we were here in the middle of COVID and people were losing their jobs, right? When those phone calls were coming in, that second conversation with me and that person was, hey, let's get in touch with your servicer. If you feel like you need me on the phone with them, I'll totally stay on the phone and we're going to talk them through it. At the company I was working at the time, we did servicing, we did it all, right? One-stop shop. So it was an easy phone call, okay? Even on the broker side, I'm still going to have that phone call with them because, going back to what you said, all-time low foreclosures, because people are making the phone calls to the lenders, letting them know the hardships that they're having, and the lenders are working with them. I tell this to every single client. The guy who we're going to call the rich man, and the guy whose debt to income was really high, and I'm questioning if they can afford this house, but it looks like they can, and that conversation has been had with this client to talk to them about their budget, to make sure that they're good with it. To also at the end of the closing say, if you ever run into hard times, the first person you need to call is your servicer. To make sure and let them know you might not be able to pay your mortgage next month, because these lenders want to hear that. They don't want to foreclose. It costs too much to foreclose. They have to go through too many hoops to do it. They want to work with that buyer. That's why you're seeing all-time low foreclosures.
Well,
because
and the
honestly,
fact that
Jim,
every house pretty much across the board, across the country, is worth more than it was last year. So
right.
you should have no problem selling.
But look right here. There's a lot of people that lost their jobs. Yep. And there was foreclosures. There were some, but people were calling their lenders, and the lenders were advertising. If you have a COVID hardship or you want to do a COVID forbearance or something, they were pushing it out there. So in my opinion, the reason it's all-time low foreclosures is they put a lot of things in there. So everybody's overly communicated. They've been doing these 30-year fixed. Their monthly payments aren't moving around. So it's in their budget. But when the going gets tough, they're making a phone call and saying, hey, what can I do to push my payment back for a little while? Right. And the lenders want to work with them. They don't want to foreclose. The last thing a lender wants to do is foreclose.
Yeah. Well, Kevin, this has been fun. It's been exciting. I really appreciate the information.
We've come so far. I mean, this started like a Facebook Live 6 years ago where we were telling ladies not to wear rompers for
the Festival
International because porta potties are disgusting.
That's right. Well, we're still the same. We're just different.
On the podcast. We have a little more gray in our beards.
But listen, we're going to put your link in there. So if you're interested in buying, selling, or just a consultant with Kevin Jones at Southern Mortgage, give him a call. His link's going to be right in the post here. But guys, I'm just honored that you guys tuned in. We'd love to hear your comments. We want to know what you think. Prove us wrong. Fact check us. Let us know. Reach out to us if you have any questions or if you want us to handle any other kind of issues. We'd love to hear you. Don't forget to subscribe or hit the alerts if you want to be notified when other podcasts just like this. Looking forward to just rambling on. I'm just going to keep going.
Keep going. So here's the thing. Always make the phone call. Dude. Make the phone call, guys. Thanks, Jim.
Make the phone call. Thanks, guys. See you next week on Real Talk.